Michael Sullivan. Now, he's a full-time trader of stocks, futures, and options. He's also the founder of TradeTheSystem.com, an advisory and educational trading website developed to educate traders on the planning, testing, and implementation of trading strategies. Now, Michael relies on his analytical approach to the markets. Strategies that have a positive expectancy coupled with solid backtesting and money management fundamentals provide an edge to his trading business. Most importantly, he maintains focus and discipline by emphasizing the psychological aspect of the business most new professionals take for granted. Mr. Sullivan has combined his corporate presentation experience with his love of the financial markets to deliver technical analysis training to investment groups, trading, and business planning at various seminars and testimonials during sponsored events. Now, he maintains a work-life balance by playing golf, coaching his 9-year-old son Jackson's baseball team, running after his 3-year-old Carter, and spending time with his wife of 14 years, Jennifer. So, Mr. Sullivan, I'm graduated with a BA in Information Systems from Old Dominion University, and with that, I give you Mr. Sullivan.
All right, thank you, and thank you to the workshop here, the Financial Freedom guys. I definitely appreciate this. I love the multi-speaker events, so it gives me a chance to research some things and add tools to my toolbox. And what I'm going to bring to you today is actually a presentation that I've been working on, and it's been in development unknowingly to myself since 1999, and it's the stock market landlord tactics. Before I get into that, well, let's make sure, can everybody see the slides? Okay, so it looks like we can, and I do apologize if I sound like I'm in a hole. It's not my microphone, it's not your speakers. About Tuesday, my son, my 3-year-old, who I'll introduce here in a second, brought home a nice little cold from daycare, so I do have a little bit of a tunnel voice today. I do apologize for that, but we'll get through it, and it's not the voice, it's the quality of information is what I always say. So bear with me, and hopefully I'll give you a few nuggets that you can take to your trading, tonight in your research, in your weekend research, and then on Monday as well. So risk disclosure, I think a lot of people have this. It just says that trading is a little bit risky. If you don't have the money to lose, you shouldn't play it. These are not FDIC insured trades that I'm going to go over. They're not guaranteed, but then again, to get that guaranteed money, I think right now they're giving you 0.7% at the banks. So I consider that losing money. If you're only making less than 1% a year on your money, I consider that more of a risk than the disclosure here. So, but it is there. Trading is risky. Don't trade with anything you can't afford to lose. So before I get into the actual meat of the presentation, I think it's important for you as a trader and an investor to have a purpose for your trading. And everybody wants to make money. I understand that. But that's not the driving force, and that's not going to give you, just being able to make money is not going to be the commitment that you need in order to succeed in this arena. There's got to be an underlying reason as to why you're doing this, and these are my reasons right here. In the bio, you heard my 9-year-old son Jackson and my 3-year-old Carter. He's actually 2 years and I think 11 months and a couple of weeks, so he's got a birthday next weekend. And I put a couple of these pictures up for a significant reason. Number one, to show you're a real person, to show that, hey, I sit here and come in and I have a little desk, an office with a few monitors, a couple of computers, and it's a real way to make a living. And the tactics that I'm going to show you are the way that you can generate enough of an income to support your family and to support the reasons that make trading the best profession in the world. Why do I say it's the best profession? Because it gives me the flexibility to spend time with this group here. And the reason I put this picture in the middle, you can see the little 2-year-old. He's a handful, and I always said if we'd have had him first, Jackson would have never been here. But I say that jokingly. I love both my kids. But this is Carter right here, the small one in the middle, covering his face. And I like to tell people that he's just showing, he's copying his dad's expression when a gap trade in the morning doesn't go well for me in the futures market. So, you know, he's got that at 2 years old. He's already got that emotion down. And so what we're looking at is that's just yeah, I know we all feel like that sometimes. We want to cover our face and hide, but you know, that's the interesting thing about the presentation today is I'm going to speak to you about what's supporting this group right here, what's supporting you know, the lifestyle that I'm allowed to live, and the way that I'm allowed to support my family is through a lot of these trading tactics. Raphael, how did I definitely married up. I'm not the most handsome guy in the world, that's for sure, and you don't have to be handsome to trade, but I definitely married up. I'm very blessed to have such a wonderful family. So that's who I am. I did graduate from college, and I went into corporate America. About 8 to 10 months into corporate America, I said, man, I want to work for myself. I want to do things and own my own business, because corporate America required me to be there on their schedule. And it took time away from then my fiance and now my wife. Corporate America took that time and flexibility away from me because they dictated when I was supposed to be where. And I didn't like that. And I knew in order to get a family and to support the family and to actually raise the kids that I wanted to raise, that I needed to make sure that I was working towards a way to get a flexible work environment. It took me 9 years. I'm a little slower than some. It took me 9 years to do what I wanted to do. So I stayed in corporate America for 9 years out of college. And then when I left, I only had one kid, and Carter has since then joined our family. And it's been the biggest thing in the world for me to have a profession and a passion that allows me to control my schedule. And that's something that I think trading gives you. Active investing gives you that flexibility. So let's go ahead. That's who I am. That's why I trade, and I do think that's very, very important. So let's talk about one other step. So back in about '99 was my first exposure to the options markets, and I am listed on the speaker event as kind of a futures trader. I do trade stocks, options, and futures, and the options and futures are a pretty substantial part of my income. Now, I day trade futures because my kids are in school. My wife has a passion of her own, and that's educating our children. She teaches at the school here. So during the day, I'm left by myself. So I've got to do something, and the passion that I have for the financial markets is kind of what I follow. So, you know, I get to sleep in a little bit. They get to go off to school. I run my 3-year-old to daycare. I drop him off, and then about 12:30, 1 o'clock in the afternoon, I have the flexibility to go pick him up if I want to. I have the flexibility to answer questions from clients, from students, from anybody. I will fill my day up with as much or as little as I need to for that particular time frame. If I'm at the beach with my family, obviously I'm available by email, but I'm not present, in the markets. But the markets offer that flexibility to get away in that fashion. I thought the perfect profession when I was in corporate America was real estate. So what did I do? I started buying real estate. I said, man, what better way than to spend money once and to keep getting paid month after month after month. Though I don't know if any of you have dabbled in real estate or had any investment property, but the thing that I'm going to tell you is it's not all, the picture is not always as pretty as you see, or I think a lot of people refer to it as the grass is not always greener on the other side. And what I mean by that is I started buying property and I was collecting this rent. And the thing about it was people could call me in the middle of the night saying their faucet was broke, or they didn't have electricity, or their water was, busted, or air conditioning going out and everything. And I was it got to where when we got to 14, 15 properties, I was getting called more often than I wanted to get called. And in 2004, I actually ran across someone, and I had been dabbling a little bit in the markets, but I ran across someone who introduced me to options and how to manage a stock portfolio. in the same way that you manage a real estate portfolio without the need to call electricians, plumbers, search for tenants, deal with vacancy rates, and all of that, wonderful stuff that goes with the real estate market. In the stock market, I can do what I've coined as the landlord setup, and it's the way for me to get a stock portfolio, treat it just like an apartment building, and get paid for one decision or one series of analysis, and then I just keep getting paid over and over and over. And then, like anything else, if you get real estate in a high growth area, sometimes people want that real estate worse than you do, right? And they'll bring you an offer, and I'm a realist. I'm going to take that offer and I'm going to run. So I have the ability to do that right in the real estate market. So what I want to do is I want to show you a little bit of that tactic today, and get it to where you can produce your own portfolio and make money all the time, each and every week, each and every month. We've had a wonderful, wonderful bonus to our profession with the invent of weekly options. And I heard another one of the presenters say something about they were talking about daily options. Well, I don't know about daily options. I don't want to work that much, but I do like the flexibility of weekly options, and they have enhanced the portfolio returns. Now, why do these tactics work? Anybody will tell you, you need to start investing early. You need to have the benefits of compounding and your money making money. Well, Albert Einstein summed it up. He said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. If you look around most towns, most cities, around the country, who has the biggest buildings? Who has the nicest looking, buildings? A lot of them are going to be banks, your big banks and things like that. If I look around my town, 2 banks just put up brand spanking new buildings. Did they put up little, small little buildings and things? No. Brick front, nice tall front towers with glass all over it, nice big fancy signs, and who's your sponsors at all of your local events? Your banks. Your banks are going to be whole sponsors at golf tournaments. Your banks are going to sponsor your school systems. Your banks, why is that? It's because they all know that when people deposit $100 to them, they're paying them 0.7% in interest for a year, and they're turning around in the overseas markets and the overnight markets, and they're making, 0.5% a night, or 1% a night, or whatever. So they understand the value of compounding. And if you use the banks in the form of the compounding, what you're doing is you're borrowing interest, and they're giving you an amortization schedule that makes you pay them interest, right? And so you're not only paying interest as the loan at the beginning of the loan, you're paying interest, and then you're paying interest, and it's not going against your principal. So why the landlord tactics work is because it takes advantage of compounding. And what I mean by that is it allows you to roll your portfolio quicker and quicker and quicker at other people's expenses. So I'm going to show you why that says that. Now, not all things are as they seem. So we've had the risk disclaimer, and you've heard some other people talk about, certain gurus tell you to do this, certain gurus tell you to do that. You need to make this fit your own personal style. And if you've got, I started my 9-year-old son, my 9-year-old Jackson started his portfolio, his landlord, if you will, portfolio with $5,000 when he was 5 years old. Now, that's grown. I've got one of his trades that I'm actually going to show you how we got into that trade a while back in later on in the presentation. But if you've only got $5,000 and you're trying to trade futures for income and you're trying to grow wealth, the landlord strategy is probably not going to be for you. I'm not going to show you how you can take a $400 investment and turn it into $4,000 in 2 weeks. That is not what the landlord portfolio is designed for. What the landlord portfolio is designed to do is to show you over the series, and it may take you 5 years to do 100 trades. It may take you 6 months to do 100 trades. I don't know what your portfolio size is, but what I'm going to show you is how to consistently and I'm going to say safely grow that account over time, trade by trade, by limiting your risk. So I'm not going to focus there. You know, a lot of the other presenters have done a great job of focusing on the upside and the profit potential. I'm actually going to focus on the risk control that the landlord provides you, because if you can hold on to a trade in the markets, especially right now where we've got an overall uptrend, you're pretty much, you just buy and hold, and it's going to work. And then when we get those signals, those topping signals, and a technical break, then you've got to change your investment strategy. But if you can control your risk on the downside, your upside will take care of itself. And that's the one good thing that I'm going to show you on a risk graph coming up here, is how the landlord strategy allows you to hold your position yet still benefit from upside moves, and that's with the use of the combination of stocks and options. So really looking forward to introducing you to a different way of trading, a different way of entering the trades. And then the great thing is you can take the nuggets that you've heard from these other speakers and you can enhance the landlord, your stock picks. The guy before me, I think his name was Vince, he said you've got a bullish engulfing pattern that he's really, really confident in. That's actually a scan that I do in the landlord play. I look for those bullish engulfing patterns and bearish engulfing patterns. So, you know, you can take the nuggets that you've learned, put it in the structure or framework of the landlord strategy, and really help your portfolio. So let's go ahead. Let me finish up. Like I said, you've got to watch, you know, what you're dealing with, because it's got to fit your personality. And Albert Einstein has been a man who's gotten credit for a lot of quotes. This was the funniest thing that I saw, because a lot of things are attributed to Albert Einstein. And that's why what I want you to do in my presentation, I want you to trust what I say, but I want you to verify that I'm telling you right, because some things are not always as they seem. And another quote they put on the face of Albert, and I know he probably didn't say this, but he said, "I never said half the crap that people said I did." So I thought that was pretty funny, and that's not that's obviously a little photoshopped image there, but I thought that's interesting, because the compound interest is important. All the things that I'm going to tell you are important, but you've got to put it in the context of your trading portfolio and make sure that you're weeding through a lot of the crap that's out there. And, you know, just like I said, trust but verify. So let's see what we're going to do. We're going to talk about the old way of thinking. I'm going to show you a couple of key components that you're going to need to know about in order to make this work. And what I'm going to do is I'm going to go through the phases of the landlord strategy, show you a couple of tips, and a checklist to go through. So let's not waste any time. Traditional way of thinking, and you may have heard this, I guess it could work in a really bull market like we've been in. People can get used to doing this, and they can get some pretty cheap insurance. But the first thing they teach you, excuse me, after you get in a position, and whatever position, you know, like I said, there's millions of ways of getting in stock. You're down here at support, so you bought support. The stock's popped. All right, it's come up. You've got a little profit, so you sell a call up right above the strike price, right? We all know that at the money calls, if you sell the at the money calls, you get more value, more extrinsic value than you do if you sell the in the money calls, or if you go way out of the money, you don't get a whole lot of time value for that. So you sell the call, and then you come down here. You need to have a put, and the put needs to be below support, right? That's called a collar trade. And if you're not understanding these terms, a couple of people have made some offers. I'm going to make you an offer. So if you're not understanding these terms, I do have an offer at the end of the slide that will bring you up to speed and get you completely ready to do all of the trading. So don't feel intimidated by the terminology that's being used. So we've got a collar set up here that ensures your risk. Well, what have we done? We've also capped our upside. So this is the old way of thinking. This is not what I'm teaching or what I do in my current portfolio, especially with the invent of weekly options. What was that, about 2 years ago, I believe. So we're going to get away from this style of thinking. We're not going to cap our upside. What we're going, and then the worst thing you can do is say, oh, I don't need a stop or protection. I don't need to worry about my risk because I know I'm going to be right on my stock. Well, I can tell you, I'll raise my hand to this question, and don't have a problem saying this. I am not right 100% of the time. I'm actually not right 95% of the time. With this strategy, if you wanted to fix trades, there are repair strategies that you can probably get back to where you lose, only a few percent, but I can't guarantee you that every single trade is going to be a winner. I can tell you that every single trade, I'm not going to risk more than X percent, and you can define that because you'll know what you're risking going into the trade rather than having to react to the markets after you've been in the trade. So let's go ahead and talk about the two things that are paramount. I mean, these are most important to any options trader. Now, some of the guys have already hit on this, so I'm not going to go through a lot of it, but I do need to mention the first thing is time decay. And the real key takeaway here is the time decay determines which options we are going to buy and which options we're going to sell. So if you're on the buying side of the market, if you are going long, I don't care, puts, calls, whatever you're going long with, which one of these months to expire are you most interested in? Well, if we buy options, they're going to be cheaper the closer, to expiration they are. Cheap is not always, inexpensive. There are two different terms. There are cheap options and there are inexpensive options, and they have nothing to do with price. So I would rather, if I'm going to hold a stock for 3 months, or I'm trying to get a move within 3 months on a stock and I'm using a call option, what do I want to be fighting? Do I want to fight a 10% drawdown in the price of the option due to time, or do I want to fight a 60% drawdown because of time? Now, I'm going to pause for a second there because that needs to sink in, because people don't think about it like this. They're like, oh, well, here comes earnings. I'm going to expect, the stock to pop in 2 weeks because here come, the earnings are here. But so they go out and they say, all right, I'll give myself 4 weeks worth of time. They'll give themselves 1 month worth of time. Well, you're at the steepest acceleration of the time decay on that option. Okay, so spend a little extra, and then if the move doesn't happen and you're still bullish on the stock, you haven't lost a lot of premium. Whereas here, if 3 weeks goes by, you could have lost, a lot of your premium, and now you're fighting oh, it's expiring in 2 weeks, and I have, I don't think there's any catalyst for the stock to move. Or more importantly, I have lost the ability to repair that option play, okay, because you don't have any time left. Given time and given money, a lot of these option plays can be repaired. So give yourself time. So what we're going to focus on is the options that we buy. We're going to make sure we're not getting killed by what's called theta, time decay. Okay, so we're going to focus in this green area, this A area. Well, what do we want to sell to people? Okay, we're just trying to, the speculators, they need some liquidity in the market as well. So somebody's got to provide that liquidity, right? So we're going to give them all the liquidity they want. We're going to sell the short-term options, and that way we're going to take advantage of the time decay instead of the time decay taking advantage of us. Really key concept. Like I said, some people have touched on it already, but it's an often overlooked aspect of options trading, and it's why a lot of options trades do not work out. The other thing is the break-even. What does it take to recover from a loss? And this is why, this slide alone is why I'm going to focus on risk control today. Because if I can get you to control your risk, then I don't have to worry about you trying to be a hero and taking that huge drawdown that often, a lot of people say, oh, well, you can't, get killed on one trade. That's why you're only taking a certain amount of risk. Well, I'm here to tell you that if you get emotional, one trade can blow your account out. It's very, very difficult for one trade to make you enough money so you can retire. So if we can live to fight another day, we're going to be better off. Now, I don't want to just live to fight another day. I want to actually have a chance at making money in this business. Okay, so if I lose 10%, I've got to make 11.1% in order to get back to break even. Before I make a dime, I've already got to make 11.1%. Okay, look what happens as you go down this list. If I get to 25%, I've got to make 33%, and this is not making 33% on my money. This is to get back to break even. Huge, huge importance here. Okay, these two concepts, the time decay and the break even curve, are very, very important. because I've taken a trade and I've made 139% overnight or 132% overnight. I can tell you I can probably, well, I've been trading for about eight or 9 years now, so I've kind of filled up one hand with those trades, but I can remember most of those trades. I can't remember all the times that I've taken 11.1% out of the market in 3 to 5 weeks. Okay, there are definitely more plentiful trades out there that are going to give you 11% over the course of 3 weeks to 3 months to 8 months or whatever, than there are 139% or 132% in 12 hours. Those are great bonuses. Don't get me wrong. Love making those. Love it when they happen to my account. But it's not something that each week I go into looking for that one trade that's going to pop like that. Okay. What I have seen, though, is people have taken these risks and they have lost 20% on their account because they didn't have stops or risk protection in there. And that makes it to where they're relying. I mean, look, when you get down here, if I lose half my account, I've got to double my account just to get back to break even. I've already told you that I don't see many triple-digit returns very often. And like I said, occasionally, yeah, they'll happen. And the more time and that you give it, the better chance you're going to have at getting those big returns. But they're not going to happen overnight for you. But what can happen is you can dig yourself a hole that is too steep to get out of. Where is that hole? The 30% level. If a trader comes to me and like seeks out a mentorship or something, and they tell me they're down more than 30%, then I'm going to pretty much tell them they've got to work on their psychology more than they have to work on anything else. Okay, so I just want you to be aware that one mistake can cost you multiple wins to get back if you can't keep those losses to a minimum. 5% is what I strive to keep my losses under. I try, when I put a trade on, I try to risk less than 5%. Anywhere from, and occasionally if the market's needing to, I'll offer it 6%. But why do I want to keep it under 10% or around 5%? Because it only takes, I can run at 50% and I'm almost break even there. Okay, and I run a little bit higher than 50% with my win-loss rates. But it doesn't take me an astronomical amount to get back to break even. It just takes me a nice little winner. A normal winner and a normal loser, I'm still at break even. I'm not giving the market that edge. So those are two concepts that I want you to understand when we get into the why I'm controlling risk. So people have already talked about calls and puts, so I'm going to skip through that one. Phase one of the 3 phases in the landlord strategy is the initial risk phase. We also have a risk reduction phase and a cash flow phase, okay? And again, I'm going to speed this up because, we are under time constraints. But this stuff, if you understand those first 2 concepts, all of this is going to fall in place. And the more and more you see this, the more and more it's going to fall into place. I'm going to go in with a married put strategy. Now, I'm not going to do the old way of thinking. I'm not going to buy, a put below support, out of the money, and have it as a quote-unquote insurance policy. My put is going to be my exit policy, my exit strategy, if you will. So if you've got to strike a stock price and a profit and loss graph, if you buy stock, this is what your risk graph looks like. It has to go up for you to make money by itself, okay? If you buy a put, the put, it's limited to the downside by what you spend on it, but as the stock goes down, your risk or your reward, quote unquote, is theoretically unlimited, but I mean the stock can only go to 0. So technically you do have a capped reward when the stock goes to 0. You're probably not going to hold the put all the way to the stock going to 0. So you've got your put graph and your stock graph, okay? So I like to keep my upside open and limit my downside. You've heard let your winners run, cut your losses short. Well, this married put does exactly that, because the put that you have in place when you marry the stock price controls your risk to the downside. You can only lose so much money because your put will then activate, and dollar for dollar you'll be able to get out of the trade. And then your upside stays unlimited because you've married the long stock. So you still get the benefits of the long stock, you still get the benefits of this risk graph, but you've got also the benefits of the put protection. So to me, that's the best way to let your winners run and cut your losers short. Now, a lot of you are going to say, okay, well, I've learned some stuff today. All that is a long call risk graph, right? Long call, married put, same thing. No, it's not really, because the tactics that I'm going to use to pay for my insurance policy to move this red line, this horizontal red line up to above this black line, and to get me above a break even on the trade, some of those tactics are not available for a long call trader, but they are available to married put traders. Okay, so it looks expensive, but again, like I said, there's inexpensive ways to trade and there's cheap ways to trade. This is an inexpensive way to trade, but it's not a cheap way to trade. Okay, so keep that difference in mind. So the first thing we've got to do is we've got to scan for candidates. I've got 3 methods that I use to scan for them. This one's actually a free tool. It's called FinViz, and they have a screener. If you're using Thinkorswim, TradeStation, all of them have built-in scanners. It doesn't really matter to me what you use because we're going to have put protection, and I'm more concerned with how the option volatility is working in relation to the stock and how much risk it's going to afford you versus the chart pattern or anything like that. Now, chart patterns are important. The better off you are at picking the stock, the better your returns are going to be. Okay, so I'm just glossing over it because of time, because the important meat of this is going to be the put option to buy. So you stand, you've got your option, let's say it's Celgene Corporation. This is not a bad one to trade right now if you've got some capital. It is a higher price stock. You can see at the time I took this snapshot, it's 88 bucks. I think it's trading a little above 90 now or something like that. But which option do we buy? Okay, there's a lot of put options. Somebody earlier showed you an option chain. There's a lot of options out there that you can buy. So let's take a look at an example here. We're going to look at the August 14 option. I've got it circled right here. And if you're not familiar with Thinkorswim, you know, this is the way that it produces your option chains. Here's your strike price. Here's your expiration date. Here's your bid ask. Okay. So I'm going to look at a $90 strike price, and the bid ask is 201 by 228. Okay. Well, let's compare the August expiration of that $90 option to the September $90 option to the October, and then we're going to compare the January options. Okay. So let's look at what those options look like, because this is what is the scanner? Finviz.com. It's a free. They have a pro subscription. I don't get paid or anything for them, but they have a scanner. I think SmartMoney.com has a scanner. There's a whole bunch of scanners out there. I use TradeStation's hot list, and TradeStation's scanning tool is what I use a lot of. But I do use the free scanners occasionally if I'm looking for, you know, specific things to buy. So let's look at those different strike prices. You can see all of them are $90 strikes. Okay. Now, when I look here, amount risked. Okay, it looks like the cheapest option is the most inexpensive, right? You're only paying 74 cents for it, and these prices are taken right from that option chain. So 74 cents versus $1.96 versus $3.16 versus $5.81. This looks like a real expensive option. This one gives you a whole lot of days to trade. Okay, let me go back to the previous slide. You can see how many days you get. You get 155 days, and this was taken, I think, earlier this week or last week. You get 64 days, 36 days, and you get 8 days. So these actually expired. These were weekly options for this past Friday. So how much does that cost per day? Because that's what we're interested in. What is the value we're getting? Well, the cost per day is 9 cents a day on that 74-cent option. It's 3 cents or 3.5, almost just under 4 cents a day for the January option. So if we're looking at this from a value standpoint, do you want to spend 3 cents a day, or do you want to spend 9 cents a day? You want to spend 3 cents a day. So can we all agree that the most inexpensive option per day is the January 15 $90 one, right? The $90 put. Okay, that's where we're getting the most bang for our buck of these options listed. All right, well, let's look at the Januaries. Let's look at the $90 strike price, the $92.50, the $95, and the $97.50. How much do they cost? Again, don't let the price dictate what you're looking at. Let's look at the value. Now, you've got to pay for this. The market has to pay for this. So we can come down here and spend $12.10, and we're only risking 3%. But you've heard no risk, no reward, okay? We've got $12 to make up in selling premiums before we start making any money. Now, in the advanced class, that's not entirely true, and I'll show you why. But for these purposes, we're going to say, hey, I'm okay with 5% risk. And I told you that's what I like to stay with. So if I can get in this trade and I can do 4.9% risk by doing the 92.50, I'll pay up a little bit, okay? And you look right here. You're only paying, you know, a little bit more for $2.50 more profit, because remember, this is our exit point, right? This is our exit. When we buy the put, what are we buying? We are buying the right to sell. So if we buy the stock at 88.46, we're actually going to be able to sell it at 92.50, right? Now, they're charging us $8.80 to do that, so we do have 5%, let's round and say 5% at risk. Again, all the math becomes second nature. Don't be intimidated by it. It will become second nature. You're looking for anywhere from 4 to 7% risk. So any of these top three are doable if you think the stock has that much room to go. If you don't think the stock has that much room to go, again, your stock opinion does matter. Okay? So that's the entry phase, and it's that simple. You buy the stock and you buy the put. You buy the in-the-money put where your risk is about 5%. And that's a guideline. Sometimes you got to pay 6%. Sometimes you may get a deal and it's 4%. But we're never risking 15, 20% on a trade. Why? Because if the trade doesn't work, then we're in trouble, right? We're getting into that point of no return. It takes us 33% to get back rather than a normal winner, okay? So that's why we're doing that. That's why we're going in the money, and that's why we're controlling our risk. Phase two, the risk reduction, and I have kind of I'm running out of time. I know I've got 5 minutes left, but I've got a lot more material to get through. So unfortunately, I'm going to speed up a little bit. But what you're doing is in the risk reduction phase, you're going to be selling, previous slide. You're going to be, these are expirations, these are Fridays. So you're going to be selling different strikes against this. Now, I'm going to teach you how to not cap your gains, because what I do is instead of, and this is the Disney chart, instead of selling calls and doing a quote-unquote covered call strategy, I'm going to show you how to do a spread, and I'm going to get the market to pay for that spread. So you can do ratio spreads or just vertical spreads, and you're going to do those with, like, remember the time chart? We're going to sell at the money or just outside of the money with very little time. Because why? Because we want to take advantage of the time decay, and we've got that put option that is not being hit by time decay because it's so far out. Okay, so hopefully you're beginning to see the structure here. Let's go. The cash flow phase is the exact same thing. It's just after you get to break even, you don't have to worry about covering your costs, because your cost is covered. You can be a little more aggressive. You can go for a bigger return. You can try to get out of the stock if it's at resistance, see if the market will pay you what I call retail in that sense. So let's talk about this. You can sell calls up at these swing points. You can use other tactics. I've talked about the spreads, which is my favorite. I love the spreads. Why? Because it leaves me that long call. It leaves me the long call, so if the stock gaps up, I'm still getting the appreciation of the stock in the form of that long call is still making me money, even though I've sold, you know, the call option. I'm still net long the stock, and I'll, like I said, I'll show you that in the offer that I'm going to make. Rolling puts, you don't always have to sell calls. If you think the stock is going to continue up like this, just keep rolling your put up. That's buying a bigger exit. So if I originally got into the 92.50 strike price, and then I can get the $95 put and not have to pay anything, then I've just increased my exit by $2.50. Okay? You follow that? Because your strike price that you were getting out was 92.50. You roll it up to 95. The stock's already gone up, so the puts are going to be losing value. So you're getting a better deal there, and locking in $2.50 worth of income. There is hidden value. Once the puts go up, remember we bought time. So has the put gone to zero? No. The put that we paid $8 for may still have $3 worth of value. Well, the stocks went up. That's covered the $5 loss. Maybe the stocks went up $6.50. And again, guys, I know I'm getting technical and I know I'm getting a little numberish, but once you see these, you'll know it'll become second nature to you. The framework is laid out just like this. You've got a stock and a put to begin with. In your risk reduction phase, you're going to be selling spreads or selling calls. And then in the cash flow phase, you get to roll your puts to lock in additional profit. You get to sell more calls, or you can repeat the spreads that you've done, okay? And that's how the whole framework works. Some boosts to consider. You've got weekly and monthly options. You've got deep in the money leaps that work sort of like the stocks, vertical spreads, ratio spreads, and the cool thing that you've got, our business is evolving, so people are offering portfolio margin now. So I thought that's pretty cool. If you're only holding margin against what you've risked, well, we've already told you you're going to free up a lot of your capital to use over and over again because we're only risking 5%. So it's often much easier to tell what will happen to the price of the stock than how much time will elapse before it happens. Now, I've done a poor job here of managing my time. I do apologize. I'm not going to penalize the next speaker for that. So I am going to kind of shoot through these next couple of slides and let you know what I'm doing going forward. So the checklist is available to you. I will give that to you. You can take a quick screenshot of it. And then the tips, the 5 tips. Control your losses, keep your good tenants, buy quality, and your market outlook matters. Don't, your stock opinion does matter. And don't abuse your leverage. You've got to keep it simple.